Hey everyone, welcome back to Corporate Decoder. You know, it's always juicy when a company drops its quarterly report, but with Tucson Electric Power, it feels like they're juggling a crystal ball and a calculator trying to predict the future of energy while keeping the lights on for everyone. Before we dive into the juicy details, if you like getting these unfiltered looks into how big companies operate and what their numbers really mean, make sure you hit that subscribe button and sound the notification bell. Also, we have a great community growing on Discord, so come hang out with us and chat about these filings. The link is in the description below. Alright, so we're looking at TEP's quarterly report for the period that ended June 30, 2025. In simple terms, they're telling us how they did over the first half of this year. And let me tell you, there are some interesting numbers here, particularly when we look at their revenues and expenses. Let's get straight to the heart of it, the income statement. For the 3 months ending June 30, 2025, TEP reported operating revenues of $407 million. That's a bit lower than the $430 million they pulled in during the same time last year, a drop of over 5%. It seems like the total operating revenues went down mainly because their retail sales took a hit, not by a huge amount, but enough to notice. They also saw less from their short-term wholesale business. Now, why the drop in retail sales? Well, it looks like they had lower cost recoveries through something called the PPFA rate, which is basically a way they pass fuel and purchase power costs onto customers. But hey, on the flip side, their transmission revenue actually went up a little. Transmission is like the highway system for electricity, and TEP is collecting more tolls, perhaps because they've invested more in it. Looking at their expenses, they spent less on fuel and purchase power in the second quarter of 2025 at $117 million compared to $14.5 million last year. But don't get too excited about fuel savings because their actual fuel expenses went up due to higher gas prices. The decrease in the total fuel and purchase power bill was mostly because of a significant drop in what they call PPFAC recovery treatment. It's a bit of a regulatory dance where they defer costs, and that deferral changed, meaning less went through their books as an expense for that specific period. Their operations and maintenance expenses went up slightly in the second quarter of 2025 to $111 million, millions from $106 million the year before. It seems like keeping their power plants running cost more this time around. And here's a big one for expenses. Interest expense jumped significantly. In the second quarter of 2025, it was $31 million compared to $24 million 2024. That's a jump of about $7 million, the 2024, and again in February of 2025. More debt means more interest to pay, which eats into profits. So with all these changes, their net income for the second quarter of 2025 came in at $72 million. That's slightly up from $70 million other areas to offset that. Now let's look at the balance sheet where a company keeps track of what it owns and what it owes. On the asset side, their utility plant, which is basically all their power generation and delivery infrastructure, is getting bigger. It's net of depreciation and it stands at about $6.8 billion net infrastructure, which is good for reliability, but also means more debt might be needed. And speaking of debt, their long-term debt is also growing. It's at over $227 billion at the end of June 2025, a noticeable jump from around $2.5 billion at the end of 2024. This increase is tied to those new debt issuances we saw impacting their interest expenses. On the equity side, their shareholder equity increased to $3.2 billion from $3.1 billion, showing some growth in the company's book value. When we look at cash flow from investing activities, this is where companies spend money on long-term assets like new power plants or upgrades. TEP significantly increased their spending here. For the first 6 months of 2025, they spent $468 million on these activities. That's a substantial increase from 26 million increase from 20 investments in infrastructure, perhaps for new renewable projects or grid upgrades. And where did they get the money for all this investing? TEP brought in a lot more cash from financing activities. In the first 6 months of 2025, with $242 million coming in compared to just $1 million last year, this was mostly from issuing new debt, as we saw earlier, to fund those investments. It's worth noting that TEP is making big bets on battery storage. They've got a project called Roadrunner Reserve 2, and it looks like they are really investing in it. This battery system is designed to store energy from renewables and release it when needed. It's a sign that TEP is looking towards a cleaner energy future, but also investing heavily in it. They've also got Roadrunner Reserve I, which is already up and running since July 2025. Now, here's something interesting outside of their own financial performance. The city of Tucson is looking into whether they should take over the electricity service themselves. A study suggested it might save customers money, but also carries significant risks and costs for the city. It's a sign that the traditional utility model faces questions, and TEP needs to stay competitive and efficient. TEP talks a lot about looking ahead, and they mention a lot of potential risks. Things like government regulations, changes in energy policies, and even extreme weather can impact them. They're trying to transition to cleaner energy sources, but that comes with its own set of challenges and costs. They also mention a potential exit from coal by 2032. Let's talk about costs. The average cost of coal power has gone up quite a bit, from 3.53 cents per kWh to 4.42 cents per kWh. Natural gas prices have also risen significantly. Purchase power costs have also increased. This means the cost of producing electricity is going up due to market prices for fuel and power. Their income tax expense for the first 6 months of 2025 was $17.6 million down, slightly from $18 million in the same period last year. They also received some benefits from something called production tax credits, which is good for reducing their tax bill, especially with their investments in renewable energy. So what's the verdict on Tucson Electric Power right now? Well, on one hand, they are making significant investments in their infrastructure and in renewable energy and battery storage. This positions them for the future and aligns with broader trends in the energy sector. The increase in utility plant and capital expenditures shows this commitment. However, on the other hand, they are taking on more debt to fund these investments. This is leading to higher interest expenses, which is impacting their profitability. Their operating revenues are also showing a slight decline in the immediate term, which could be a sign of increased competition or pricing pressures. The fact that the city of Tucson is even considering municipalization is a red flag for TEP to remain on its toes and deliver value to its customers. They need to ensure their investments translate into reliable and affordable energy. Overall, TEP is navigating a complex environment with a strong focus on infrastructure and renewables, but they need to carefully manage their rising debt levels and ensure their operational strategy can keep pace with market demands and regulatory changes. It's a balancing act, and the next few years will be crucial in seeing if their current investments pay off. Alright, that's our deep dive into Tucson Electric Power's latest report. What do you think about their investment strategy and their increasing debt levels? Let us know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.